So, good morning, business. I'm the first reporter of Group 1, Disarel Cotillas, BSMA 3. We tackle about understanding financial statements. Introduction. This chapter provides a framework and several tools to help us analyze companies and value their securities. At this point, it is helpful to imagine yourself as a specific user of financial statements. How business activities are reported. To be able to analyze a company effectively for its value, it is important that one must understand the company's business activities. This can be accomplished through the financial statement. Financial statement report on a company's performance and financial condition and reveal executive management's information and insight. Financial statements serve the needs of different users. The operation of the accounting information system involves application of accounting standards to produce financial statements that provide the insight on the business activities of the company under analysis. Accounting information should be used in the business context in which the information is created. All companies without exception plan business activities, finance those activities, invest in those activities, and then engage in operating activities. Business firms conduct all these activities while confronting business forces, including market constraints and competitive pressures. Financial statements also provide crucial input for strategic planning as well as information about the relative success of those plans, which can be used to corrective action and make new operating, investing, and financing decisions. General objective of financial statement. The important objectives of financial statement are: first, providing information for economic decision. The economic decisions that are taken by the user of financial statement require an evaluation of the ability of an enterprise to generate cash equivalent and the timing and certainty of their generation. The ability ultimately determines the capacity of an enterprise to pay its employees and suppliers, make interest payments, repay loans, and make distribution to its owners. Second, information about financial position. The financial position enterprise is affected by the economic resources such as: first, information about the economic resources controlled by enterprise and its capacity in the past to modify these resources is useful in predicting the ability of the enterprise to generate cash and cash equivalent in the future. Second, information about financial structure is useful in predicting future borrowing needs and how future profits and cash flows will be distributed among those with an interest in the enterprise. Third, this information is useful in predicting how successful the enterprise is likely to be in raising further finance. Fourth, information about liquidity and solvency is useful in predicting the ability of the enterprise to meet the financial commitment as follows. So, liquidity refers to the availability of cash in the near future after taking account of financial commitments, and solvency refers to the availability of cash over the longer terms to meet financial commitment as they fall due. Third, providing information about performance of the enterprise. Another important objective of the financial statement is that it provides information about the performance and in particular its probability, which is required in order to assess potential changes in the economic resources that are likely to control in future. Information about variability of performance is important and useful in predicting the capacity of the enterprise to generate cash flows from its extensive resource base and informing judgment about the effectiveness with which the enterprise might employ additional resource. Fourth, providing information about performance of an enterprise. The financial statement provides information concerning changes in the financial position of an enterprise as is useful in order to assess its investing, financial and operating activities during the reporting period. This information is useful in providing the user with a basis to assess the ability of the enterprise to generate cash and cash equivalents and the needs of the enterprise to utilize those cash flow. Next is demand for financial accounting information. Decision makers and other stakeholders demand information on the company, past and prospective returns, and the rest to facilitate efficient contracting and risk sharing. The broad classes of users that demand financial accounting information include the following. First, managers and employees. For their own well-being, the prospective earnings potential managers and employees needs accounting information on the financial condition, profitability, and prospect of their companies as well as comparative financial information on competing companies and business opportunities. Management uses financial statement to raise financing for the company to meet disclosure requirements and to serve as a base for executive relation and bonuses for wage negotiations and to meet disclosure requirements. Second, financial statement are used by parties to decide. Second, investors and analyze. Financial statements are used by their parties to decide whether to buy or sell equity shares, expectation about future profitability and ability to generate cash influence and price of securities and a company's ability to borrow money at favorable terms. Other information intermediaries such as financial press writers and investment analysts are interested in the predicting companies' future performance.
So, good morning. I'm Ana Palarca, and I will be the next reporter in Chapter 11, Understanding Financial Statement. Number 3, Creditors and Suppliers. A creditor is an entity, company, or person that has provided goods, services, or monetary loan to a debtor. Generally speaking, a creditor is a supplier, a person, organization, or other entity that sells a product or service as their business. This means that all retailers are creditors because they sell products or services. However, use of the term creditor is generally only used in accounting to refer to instances where there's long-term customers or suppliers relationship. Another example of a debtor or creditor relationship is if you take out a loan to buy your house, then you as the homeowner are a debtor while the bank who holds your mortgage is the creditor. In general, if a person or entity have loaned money, then they are a creditor. Usually, each creditor has a specific agreement with their debtors about the term of payment discount. Number 4, shareholders and directors. Financial accounting information are needed by owner and directors of the company to assess its profitability and risk, to evaluate managerial performance, and to help to make leadership decisions. And shareholders and directors have two completely different roles in company. The shareholders own the company by owning its shares, and the director manage it. Unless the article says so, a director does not need to be a shareholders, and a shareholder has no right to be a director. Number 5, regulatory and tax agencies, the SEC, BIR, BSP, and other legal institutions demand financial accounting information to monitor the business firm's compliance with laws for public protection, price setting tasks, and other regulatory policies. Number 6, customers and potential strategic partners. Customers, both current and potential, need account information to evaluate a company's ability to provide products and services as agreed, and to assess the company's reliability and staying power. 7. Other decision makers. Financial account information are required to varied purposes by other parties, from assessing damages for environmental abuse to making policy decisions involving economic, social, taxation, and other initiatives. Source of information about business enterprise. In the Philippines, publicly listed companies must file financial accounting information with the Securities and Exchange Commission, or SEC. 1. The audited annual report that includes the four financial statements, statements of financial position, traditionally known as balance sheet statement, statement of comprehensive income, statement of stockholders' equity, and statement of cash flow, with explanatory notes and the management's discussion and analysis of financial results. 2. The unaudited quarterly or interim reports that include summary version of four financial statement and limited additional disclosure. Benefits of disclosure. The advantages of supplying accounts information extend to a company's capital, labor, input, and output markets. Companies compete in these markets. For instance, debt and equity financing are sourced from capital markets, and the better a company's prospects, the lower will be its cost of capital, as reflected in higher stock prices or lower interest rate. The company's ability to disclosure reliability audited accounting information about its products, processes, and other business activities enable them to better compete in capital, labor, input, and output markets. Cost of disclosure. The preparation and dissemination cost of supplying accounting information to produce competitive disadvantages is high. Companies are apprehensive that disclosure of their activities, such as product or segment successes or failures, strategic initiatives, technological or systems innovation, could harm their competitive advantages. Constraints are relevant and reliable information. 1. Timeless. If there is undue delay in the reporting of information, it may lose its relevance. Management may need to balance the relative merits of timely reporting and the provision of reliable information. Timeless is important to protect the users of accounting information from basing their decisions on outdated information. Imagine the problem that could arise if a company was to issue its financial statements to the public after 12 months of the accounting period. Number 2, balance between benefits and cost. The balance between benefit and cost is a pervasive constraint rather than a qualitative characteristic. The benefit derived from information should exceed the cost of providing it. The evaluation of benefits and costs is, however, substantially a judgmental process. The costs do not necessarily fall on those users who enjoy the benefits may also be enjoyed by users other than those for whom the information prepared. This reason it is difficult to apply a cost benefits test in any particular case. Nevertheless, standard setters in particular, as well as the preparers and users of financial statements, should be aware of this constraint. Number 3, balance between qualitative characteristics. In practice, a balancing of trade-off between qualitative characteristics is often necessary. Generally, the aim is to achieve an appropriate balance among the characteristics in order to meet the objective of financial statements. The relative importance of the characteristics in different cases is a matter of professional judgment. Through fair view or fair presentation, financial statements are frequently described as showing a true and fair view of the financial position, performance, and changes in financial position of an enterprises. And true fair view of or fair presentation is auditing means that the financial statements are free from material misstatements and faithfully represent the financial performance of and position of the entity. Although the expression of true or fair view is not strictly defined in the accounting literature, we may derive the following general conclusion as to its meaning. True suggests that the financial statements are frank- factually correct and have been prepared according to applicable reporting frameworks such as the IFRS, and they do not certain any materials misstatements that may mislead the users. Misstatements may result from material errors or omissions or transactions and balances in the financial statements. Fair implies that the financial statements present the information faithfully without any element of bias, and they reflect the economic substances of transactions rather than just their legal form. Preparation of true and fair financial statement has been expressly recognized as one of the responsibilities of the directors of companies in the corporate law of several countries, just as in the Companies Act 2006 in the UK. Auditor must therefore consider whether directors have fulfilled their responsibility for the preparation of true and fair financial statements when providing an audit opinion.
Good morning, everyone. My name is Junel S. Bayatlang, and I will be continuing the report about understanding the financial statements. Financial statements. Business activities are periodically reported by companies using four financial statements: the statement of financial position, statement of comprehensive income, statement of stockholders' equity, and statement of cash flow. So before going through, you must understand what is these four financial statements. Statement of financial position. Its purpose is commonly used to assess the position of business in terms of financial stability and potential risk. A typical statement is likely to include a snapshot of business's asset, liabilities such as loans, VAT, and corporation tax. Next is the statement of comprehensive income. Its purpose is to show an entity's financial performance in a way that is useful to a wide range of users so that they may attempt to assess the future net cash inflows of an entity. Next one is the statement of shareholders' equity or stockholders' equity. Its purpose is to enable shareholders to see how their investments are faring. It is also a useful tool for companies in helping them make decisions about future issuance of stock shares. Statement of cash flow. Its purpose is to provide information about cash receipts, cash payments, and net change in cash resulting from operating, investing, and financing activities of a company. What is the importance of financial statements? Financial statements are important to investors because they can provide enormous information about companies' revenue, expenses, profitability, debt load, and the ability to meet its short-term and long-term financial obligations or the liabilities. The three statements in the middle of Figure 11-1 link the statements of financial position from beginning to the end of a period. Statement of financial position from the beginning of the period, the statement of cash flow, statement of stockholders' equity, statement of comprehensive income. 2. The last, which is the end of period of the statement of financial position. Relation of the four financial statements. The four financial statements relate to each other and correlate to provide external users, such as creditors, customers, lenders, and government agencies, an accurate and important financial picture of a business entity. By examining all the financial statements which reveal both strength and weaknesses, good investment and credit decisions can be made by external users such as stockholders, lenders, and others. Managers can also use the financial statements information for effective financial planning and decision making. Linkage of financial statements. The four financial statements are linked with each other and link across time. The linkage is known as articulation. The statement of financial position and statement of comprehensive income are linked via retained earnings. Yes. Example: Orange Incorporated retained earnings reconciliation for the year ended September 30, 2014. Retained earnings. By the way, what is retained earnings? Retained earnings is the portion of earnings left with the company after the distribution of dividends to its shareholder. So here it is. Retained earnings September 30, 2013 worth 5,607, and then add net income, or the net income is the entity's income minus the cost of goods sold, expenses, depreciation, and amortization, interest, and taxes for an accounting period. So add net income, which is 3,496, then less the dividends, then and other adjustments. And then the retained earnings as in September 30, 2014 is 9,101. So, statement of financial position. A statement of financial position reports a company's financial position at a point in time. The company's resource, which is the asset. Just like what I've said earlier, that statement of financial position's purpose is commonly used to assess the position of business in terms of financial stability and potential risk, A typical statement is likely to include a snapshot of business assets, liabilities, such as loans, VAT, and corporation tax. There are two ways a company can finance its asset. Number one is owner financing, where it can raise money from shareholders. So, unsaon man. A company can raise capital by selling additional shares. This can be either common shares or preferred shares. Next is the non-owner financing. It can also raise money from banks or other creditors and suppliers. So, example, a company looking to raise capital through debt may need to approach a bank for a loan. This means that both owners and non-owners can hold claims on a company's asset. Owner claims on assets are referred to as equity, and non-owner claims are referred to liabilities or debt. We obtain the following basic relations. Investing is equal to financing. This equality is called the accounting equation, which follows the asset is equal to liabilities plus owner's equity. Example of statement of financial position. Blue Company Statement of Financial Position, December 31, 2011. This report amounts at the point in time. Investing is to assets. So what is investing? Investing is the act of obtaining money by building up operations or purchasing investments, products such as stocks, bonds, and annuities. So under these assets are cash, non-cash assets, the total assets, and the total resources, which is under the investing. And financing is the liabilities and owner's equity. Non-owner claims and resources is total liabilities. So, unsa itong non-owner, unsa ganito pag-raise sa capital. So, to raise capital through debt, many may need to approach a bank for a loan. So, under din siya sa liabilities kaning loans. So cover siya sa non-owner claim on resources. And the owner's equity, contributed capital, retained earnings, other equity, which is the total owner's equity is under pun siya sa owner claim on resources. So, unsa gali to katong mga unsa gali pag-raise money sa shareholders. A company can raise capital by selling additional shares. This can be either common shares or preferred shares. So, muna siya, under siya sa owner claim on resources. So, owner's equity, total liabilities and owner's equity. This is the statement of financial position. Financial statements titles sometimes begin with the word consolidated. This means that the financial statement includes a parent company and one or more subsidiaries. Companies that the parent company owns. For Blue Company, other equity includes accumulated other comprehensive income and minority interests. Investing activities. Statement of financial position is organized like the accounting equation. Investing activities are represented by the company's assets. Investing is the act of obtaining money by building up operations or purchasing investment products such as stocks, bonds, and annuities. Then the financing activities. Asset must be paid for and funding is provided by a combination of owner and non-owner financing. Owner or equity financing includes resources contributed to the company by its owners, along with any profit retained by the company Non-owner, creditors, or debt. Financing is borrowed money or debt. Kanang mga loans. Financing is the act of obtaining money through borrowing, earnings, or investment from outside sources. Working capital. Current assets are often called working capital because these assets turn over. That is, they are used and then replaced through the year. Or the net working capital is the difference between a company's total current asset and current liabilities. Net working capital is the difference between current assets minus current liabilities, while the net operating working capital is the difference between current assets and non-interest bearing current liabilities. So, what are the things under the current assets? Current assets include cash, account receivable, and inventories, and exclude marketable securities, while the non-interest bearing current liabilities refers to the amount of money a company must pay off within the year but does not owe interest on.
Statement of Comprehensive Income. The statement of comprehensive income reports on a company's performance over a period of time and lists amount of revenues, also called as sales, expenses, and other comprehensive income. So, statement of comprehensive income is a change in equity during a period resulting from transactions and other events other than changes resulting from transactions with owners in their capacity as owners. Comprehensive income includes component of profit of or loss, components of other comprehensive income. The term profit or loss is the total of income less expenses, excluding the components of other comprehensive income. This is the bottom line in the traditional income statement. An entity may use net income or net loss to describe profit or loss. Other comprehensive income. Other comprehensive income comprises items of income and expenses including reclassification adjustments that are not recognized in profit or loss as required or permitted by Philippine financial reporting standards. The components of other comprehensive income include unrealized gain or loss on equity investment measured at fair value through other comprehensive income. Unrealized gain or loss on debt investment measured at fair value through other comprehensive income. Gain or loss from translation of the financial statements of a foreign operation and revaluation surplus during the year. So this is an example of statement of comprehensive income. Blue Company, which is the name of the company, statement of comprehensive income for the year ended December 31, 2014. Report amounts over a period of time. Under is the revenues, expenses, net income or loss, other comprehensive income, and the total. Revenues are the goods or services provided to customers, and the expenses is the cost incurred to generate revenues. Manufacturing and merchandising companies typically include an additional expense account called cost of goods sold or cost of sales. The statement of comprehensive income following revenues. It is also common to report a subtotal called gross profit or gross margin, which is revenues less cost of goods sold. The company's remaining expenses are then reported below gross profit. This income statement layout as follows. Revenue less cost of goods sold equals gross profit. Gross profit less expenses is the net income or the net loss. The cost of goods sold cost is the cost of materials, labor, and overhead. Gross profit is the revenue less cost of goods sold, and the expenses is other than product cost of sales. So overall, the statement of comprehensive income is also referred to as a statement of profit or loss and other comprehensive income in IFRS. Net income or expenses is referred to as net profit or loss. Statement of comprehensive income is basically any income or expenses except those transactions with owners of the company that would or would not be reported in ordinary income statements, which is due to unfit with the definition of ordinary net profit or loss. Operating activities. Operating activities use companies' resources to produce, promote, and sell its product and services. These activities extend from input markets involving suppliers of materials and labor to a company's output markets involving customers of products and services. Input markets generate most expenses or costs such as inventory, salaries, materials, and logistics. Output markets generate revenues or sales to customers. Output markets also generate some expenses such as marketing and distributing products and services to the customers. Statement of stockholders' equity. The statement of stockholders' equity reports on changes in key types of equity over a period of time. For each type of equity, the statement reports the beginning balance, a summary of the activity in account during the year, and the ending balance. So, the stockholders' equity or the shareholders' equity is the residual interest of owners, the net assets of a corporation measured by the excess of assets over liabilities. So this is an example of statement of stockholders equity. Blue Company, which is the name of the company, statement of stockholders equity for year ended December 31, 2014. Under is the contributed capital, retained earnings, other equity, and the total. The beginning balance of December 31, 2013 stock issuance or the repurchase, and net income or loss, dividends, other, and the ending balance of December 31, 2014. Retained earnings represent cumulative balance of periodic earnings, dividend, dividend distributions, prior period errors, and the capital adjustments. So, overall, the statement of stockholders' equity tells the reader what happened to a company's equity for the reporting period, which in concept is very similar to more wide-used statement of cash flows, which tells us what happened to the company's cash. Shareholders' equity shows how much the owners of the company have invested in the business, either by investing money in it or by retaining earnings over time. On the balance sheet, shareholders' equity or the stockholders' equity is broken down into three categories: the common shares, the preferred shares, and the retained earnings. Statement of cash flows. The statement of cash flows reports the change, either an increase or decrease, in a company's cash balance over a period of time. The statement report on cash inflows and outflows from operating, investing, and financing activities over a period of time. So, a statement of cash flows is a component of financial statements summarizing the operating, the investing, and the financing activities of an entity. The statement of cash flows provides information about the cash receipts and cash payments of an entity during a period. An entity shall prepare a statement of cash flows and present it as an integral part of financial statements for each period for which financial statements are presented. The, fi- the primary purpose of a statement of cash flows is to provide relevant information about cash receipts and cash payments of an entity during a period. The statement of cash flows is designed to provide information about the change in an entity's cash and cash equivalents. Cash comprises cash on hand and demand deposits. Cash equivalents are the short-term, highly liquid investments that are readily convertible to known amount of cash and which are subject to an insignificant risk of change in value. Cash flows are inflows and outflows of cash and cash equivalents. So, this is an example of statement of cash flows. Blue Company, which is the name of the company, statement of cash flows for year ended December 31, 2014. Operating cash flows, which are the operating activities. Operating activities are the cash flows derived primarily from the principal revenue producing activities of the entity. Operating activities generally result from transactions and other events that enter into the determination of net income or loss. So, examples of cash flows from operating activities. Cash receipts from sale of goods and rendering of services. Cash receipts from royalties, rental fees, commissions, and other revenue. Cash payments to supplier for goods and services. Cash payments for selling, administrative, and other expenses. Cash receipts and cash payments of an insurance entity for premiums and claims, annuities, and other policies benefits, and cash receipts and payments for securities held for trading. Next is the investing cash flows, which is the investing activities. Investing activities are the cash flows derived from the acquisition and disposal of long-term assets and other investments not included in cash equivalents. Investing activities includes cash flows from transactions involving non-operating assets. Examples of cash flows from investing activities: cash payments to acquire property, plant and equipment, intangibles, and other long-term assets. Cash receipts from sales of property, plant and equipment, intangibles, and other long-term assets. Cash payments to acquire equity or debt instruments of other entities. Cash receipts from sales of equity or debt instruments of other entities. And cash advances and loans to other parties other than advances and loans made by financial institutions. Next is the cash flows, which is the financing activities. Financing activities are the cash flows derived from the equity, capital, and borrowings of the entity. Financing activities are the cash flows that result from the transactions between the entity and the owners, between the entity and the creditors. Financing activities include the cash flows from transactions involving non-trade liabilities and equity of an entity. Examples of cash flows from financing activities: cash receipts from issuance of ordinary and preference shares, cash payments to acquire treasury shares, cash receipts from issuing debentures, loans, notes, bonds, mortgages, and other short or long-term borrowings, cash payments for amounts borrowed, and cash payments by a lessee for the reduction of the outstanding principal lease liability. Next, the net increase in the beginning cash balance of December 31, 2013, and the ending cash balance of December 31, 2014, which is total of 44,329. So that could be all. Thank you.